In this video, I'm going to show you how Florida couples can erase capital gains tax using something called the double step up. By the end of this video, you'll know exactly how this works and who it's right for and what you're giving up to get these incredible tax savings. I'm Santiago Cueto, board certified international business law expert and best-selling author based right here in Miami, Florida. I've helped Florida families save millions of dollars in taxes that they didn't have to pay. Let me ask you something. You've spent years building real wealth, right? Maybe it's a business you grew from nothing. Maybe it's stocks you bought years ago that exploded in value. Or maybe it's investment property worth 10 times what you paid for. These are all great things, but you could be sitting on a massive tax bomb right now. It could cost your family hundreds of thousands of dollars, maybe even millions, and you probably don't even know it exists. Here's what people miss. When your spouse dies, you don't get a free pass on taxes. You're about to get hit hard, really hard. Most people think everything just resets when one spouse passes away. The taxes just disappear, but that's not how Florida works. Florida is a separate property state. That matters more than you think. When your spouse dies, the IRS gives you a step-up basis on their half of the assets, just their half. Your half is still carrying all those decades of gains. Think about what that means. Your spouse passes away. You want to sell the family business. Maybe you want to sell that rental property to simplify your life. You're grieving. You're trying to figure out what comes next. And then you get the tax bill. Hundreds of thousands of dollars and sometimes even millions, right when you can least afford it. But there is a solution. It's called the Florida Community Property Trust. Now, I know what you're thinking. Great, another trust. But this one is completely different. Just hear me out. This trust lets Florida couples borrow tax rules from states like Texas and California. You put your appreciated assets into this specific type of trust, and you unlock the double step up. Here's what that means in plain English. When the first spouse dies, the entire asset gets reset to current market value. Not just half, the whole thing. Both halves get the step up, the deceased spouse's portion and the surviving spouse's portion. So really take that in because it's that powerful. The surviving spouse could sell that business the next day. Zero capital gains tax, nothing. This is probably the most powerful tax savings available to married couples in Florida. Almost nobody is using it. Why? Because it has to be set up exactly right. You can't just shake hands and declare it community property. The trust document has to explicitly state that you're treating the property as community property. Florida law requires at least one qualified trustee. That means someone who lives in Florida or a Florida trust company. Your kid who moved to Colorado, they can't handle this. It needs a real connection to Florida. Now here's where you need to pay close attention, and this is critical. Every powerful legal strategy has trade-offs. This one is no different. The tax savings are incredible, but you're giving something up. You're giving up asset protection. You see, Florida has something called tenancy by the entirety. It's like a force field around assets owned jointly by a married couple. If one spouse gets sued, creditors can't touch property held as tenancy by the entirety. A doctor gets hit with a malpractice claim, for example. The property is protected. But when you move assets into community property trust, you walk away from that protection. The assets become community property that could potentially be reached by creditors of either spouse. Not just one spouse, either spouse. There's something else you need to consider. I know it's uncomfortable, but we have to talk about divorce. Once assets go into this trust, they're legally characterized as community property. If the marriage ends, those assets get split 50-50. You can't go back later and claim otherwise. And you can't say you inherited those shares before marriage. You can't say that was your separate property. Once it's in the trust, you've agreed it's shared equally. Now, if you're finding this valuable, do me a favor and hit that like button and subscribe to my channel. I share strategies like this every week that could save you serious money. All right, so who is this trust actually right for? It's for couples in solid marriages, long-term marriages, couples with significant appreciated assets. We're talking real wealth here. And also for couples who aren't facing major liability risks. If that's you, this trust could save your family a fortune. But if you're a surgeon who operates every day, this might not work. If you're in a business with serious liability exposure, you might want to think twice about it. If there are any cracks in the marriage, this also is probably not the right move for you, at least not right now. The drafting has to be perfect. The asset protection implications are very serious. This isn't something you figure out on your own. This isn't something you do with a generic online template. If you're thinking this might apply to you, let's have a real conversation. Schedule a strategic consultation with my firm. We'll look at your entire portfolio. We'll talk through the trade-offs. We'll figure out if the double step-up makes sense for your situation. You've worked too hard to hand a massive chunk over to the IRS, especially when there's a legal way to avoid it. Now, if this video helped you understand how to protect your family's wealth, hit that like button and subscribe to my channel for more strategies that actually work. Share this with someone who needs to hear it. I'm Santiago Cueto, your Florida business attorney. Be sure to watch more of my videos right here.